Nilesh Shah joins us now. Let's welcome him. And he's the perfect person to really explain to our viewers that why they should be believing in India. You know, I always make this point that it's quite ironical. If I look at India, foreigners, they have more faith in Indian equities as they own more than 20% of the market, and retail investors independently don't even own 5%, and mutual fund holdings directly indirectly, if I add both of them up, is not even 15-16%. So why do foreigners own more of India, and why do Indians do not believe in equity market when the economy and things are really on a roll? Nilesh Shah, good morning. Thank you for joining us. Let's try and put things in context. You know, as market commentators, when I look at the DIS selling data, it is quite, I won't say unnerving, but perhaps it's not very exciting to see that when foreigners are buying into India, they believe in where our economy and markets are headed. Indian investors are not taking that leap of faith.
So Nikunj bhai, in the month of March, there was selling by FPIs of about 60,000 crore. Mutual funds and insurance companies were buyer at that point of time. Now the role is reversed. For last 7-8 months, we have seen redemptions in our funds and hence we have to sell. The good part among those redemption is that SIP flows have continued and slowly it has made a bottom. Now SIP flows are more than 8,000 crore a month. So there is probably two parts of India. One, which is believing in growth story and staying invested for a longer term. Second, which seems to be doing some amount of profit booking.
Markets, Nilesh bhai, are up 10%, and we'll just put that data out that this is the best post-budget rally which we've seen in last 20 years. Yes, 20 years. We've not gone above beyond that data, but this decade, this century, this is the best post-budget rally. How much of the post-budget rally do you think has fundamental substance to it? Do you think markets fundamentally deserve to get re-rated post-budget?
So in some sense, market is discounting the intent declared in the budget. This is the budget where we are removing constraints which has restricted India's growth story. For example, spending money when it is due rather than worrying about what rating agencies will talk about fiscal deficit, privatizing PSUs, spending money on building infrastructure. These are the things whose intent has been discounted by the market and which is why there is a jump. It is also supported by excellent quarterly results coming throughout the budget, pre-budget as well as post-budget season. But undoubtedly, now the intent has to be converted into execution. The market is looking to the future with positivity, and this budget needs to be executed on ground.
Nilesh bhai, what are the chances that when the real economic recovery because of government spending and other factors kick in, markets or stock prices may not do anything? What I'm trying to understand from you, and our viewers are curious to know, is that markets are forward-looking and markets have moved up in anticipation of an economic recovery and earnings recovery. So when the real recovery may happen, markets would say, look, we knew this was coming and that's why we anticipated this recovery and we moved in advance.
In my opinion, if the government spending and consumption gives the first boost to the economy, thereafter there will be recovery in investment and that will create a virtuous cycle. More spending will create more demand will create more jobs will in turn create more demand. So we need to create a virtuous cycle of accelerated growth. And there are two factors which we believe will help India's growth move by probably about 2% on an incremental basis per year after some time. One will be housing and construction. Housing, construction, real estate has dropped from double digit of GDP to now mid-single digit of GDP. But now stars are aligned for this sector to revive. Housing interest rate loans are at 6.75%. My bank, Kotak Bank, provides housing loan at 6.75%. Affordability has improved significantly. Jeffrey's index is showing affordability of house have moved from 50 in 2012 to 27 in 2021. Uh, RERA has ensured that developer and the consumer are now on a level playing field. No longer developer can treat consumer as a football. And more importantly, this work from home environment, all of us are short of one room. So there is demand, there is level playing field, there is availability of money, and there is affordability. My feeling is that housing and construction is set for a multi-decade growth if these trends can be sustained. The second thing is production linked incentive scheme. For years, we have seen global manufacturing firms going to China and other countries for setting up their supply chain. Now, India is actively wooing those companies to come out of China and settle in India. And for that, we have devised a fantastic scheme, production linked incentive scheme. Earlier, it was for 3 industries, now it is for 13 industry. And this is not like textile upgradation fund where you get money for setting up a plant and then you gold plate the plant and siphon off the money and create NPA. This is all about production. If you produce, you get money. If you don't produce, you don't get money. My feeling is that PLI scheme will also add about incrementally 1% of GDP after a few years. Obviously, construction and PLI scheme put together can lift India's long-term growth orbit, and that is what will support the market once first sign of growth emerges.
Fair enough. Nilesh, what is your view on the commodity front and the kind of rally and momentum that we've been seeing there? Is that a segment of the market that you're averse to, or where that you feel we'll also find opportunity going forward, particularly on the back of growth?
So in the commodities market, Abha, you have to always keep on looking at the commodity prices, and which gets influenced not only by demand and supply, but also by other geopolitical factors, including financial pull. We have seen sharp recovery in commodity prices across, probably from agriculture basket to industrial commodities to oil and gas, and so on and so forth. Uh, our approach towards commodity price has been to invest in companies which are less leveraged, though in a rising commodity prices, leveraged companies deliver far higher return. So we are more interested in those commodity companies which will be less leveraged, as you never know when commodity cycles turn around and debt becomes a burden.
Absolutely. All right. And in terms of the kind of capacity expansion that we've started to pick up now across the board in terms of announcements coming in, not just from some of the, earlier we had the big cement majors, now we've got other niche players, paper stocks, tire stocks, a whole host of industries that are starting to look at actually expanding capacity with an eye to growth going forward. How encouraging do you find that? Do you feel this is the right time, that we're just at the cusp of the rally really?
So as of today, our capacity utilization is still 72%. Unless until this capacity utilization goes to 85%, a big bang private investment revival is unlikely to happen. We have seen encouraging signs in terms of announcements by certain leaders that's more industry specific rather than broad-based trend. We still think full-fledged investment revival is probably 12 months away, and which is where we have started seeing that industrial stocks are discounting the recovery down the line, and they have started making a bottom and improving. We have been bullish industrials in anticipation of this investment revival, and it's best to accumulate stocks when they are available rather than try to chase when the good news is out. So we have been bullish industrials in our portfolios in anticipation of private investment revival. However, I still feel that this is probably 12 months away rather than happening immediately.
Just taking a leaf out of what you were talking about earlier, the fact that, commodity prices may shoot up earlier and they are indeed on an incline upwards, and the kind of margin compression that it's going to lead to for India Inc., and especially in sectors which are already at elevated valuations.
So your point is absolutely valid that commodity price inflation is going to impact certain raw material cost, and companies which won't have ability to pass on price increase, their margins will get squeezed. However, we also have to look at margins from the other side. One, the cost has been cut dramatically across sectors. This has been cut on discretionary as well as non-discretionary spending. Interest cost has come down, working capital has been tightened. So some margin expansion has happened because of cost cutting. Second, we have seen about 7 to 8% drop in sales in September quarter, and December quarter sales drop is about 2 to 3%. Hopefully from March quarter onwards, we will start seeing sales turning positive. Nomura Business Activity Index is now touching pre-COVID level. So there is a reasonably good chance that March quarter should be positive sales. When sales are negative, to sustain margin is a miracle. When sales become positive, those margins can expand further. So the pressure of raw material and rising commodity prices will have to be negated through cost improvement, through sales growth, and by passing some portion to the consumers. We are interested in those companies which are able to have these three characteristics, and hence their margin can expand despite raw material price increase.
Sure. Purely in terms of an asset allocation, Nilesh, and I'm not talking about direct equities here, I'm talking about mutual funds. Does it still make sense and for the continued future to have a larger exposure to equities as opposed to fixed income?
So our request right now to investors is that markets are at fair value. It's no longer cheap like March, April, May, June 20. So have equal weight allocation to equity. And equal weight doesn't mean that you sell off your equities. It means that you maintain that portion of equity which your risk profile permits. This is neither the time to be overweight equity nor the time to be underweight equity. This is to follow your disciplined asset allocation model.
Nilesh, I have a very simple question. Why should one have exposure to bond market when we know that interest rates from here will not go lower and inflation from here will go higher? There is a scope for bonds to underperform when both inflation and interest rate factors are against you.
Undoubtedly, Nikunj bhai, this is the market where, as you correctly mentioned, inflation and interest rates both are standing against the bond investors. But this is where fund manager skill comes into play. You have to ensure that the coupon income which you make in bond is reasonably good enough over the capital loss which might come because of rising interest rate. Second, the rise in interest rates, it's not going to be secular. It will be controlled by RBI's intervention. We did see post-budget 10-year yield going up. Then RBI took certain action in terms of cancellation of auction and yield did reverted back. So there will be opportunity for skilled fund manager to navigate in this turbulence and still generate return. So we recommend investors today in bond market to invest in somewhere around medium term, say between 3 to 5 year kind of products, and also dynamic bond fund. Credit risk funds now seems to have made a bottom. They were seeing redemptions since April all the way up to December. But in the month of Jan, we have started seeing inflows back in credit risk fund. Those funds are having higher credit risk, but in terms of duration, they are generally at the short end of the curve. So there are certain products within mutual fund portfolio in fixed income which will help you protect yourself against rising interest rate, from extremely short-term funds like overnight and liquid and money market, to medium-term funds like floating rate fund, corporate bond fund, banking and PSU debt fund, and finally a dynamic bond fund. These are all the funds which will help you make money even in a rising interest rate environment.
Is it time to now, let's say, have a tilt towards small and mid cap stocks? I mean, start a SIP, if not direct investing?
Definitely, Nikunj bhai. Within equal weight equity allocation, our call is that it is time to be marginally overweight small and mid cap and marginally underweight large cap. While large, mid and small seems to be equal in terms of valuation vis-a-vis their historical averages, Large caps are at a slight premium and small caps are at a slight discount. So undoubtedly, purely from a valuation point of view, small cap today appears to be overweight. We also believe that small cap stocks will benefit far more in terms of recovery as their volume picks up. The large cap companies by and large were able to withstand COVID-19 shock quite well. The small caps had to go through the pain, and now probably it is time for them to reap the benefits.
Absolutely. So, do you see markets perhaps stabilizing, moderating, let's say by the year end, Nilesh, or do you actually have a much higher year end target? I'm just trying to get a sense of the kind of average return expectations that perhaps retail investors should have at a time like this, given what we've now seen the markets go through.
So my request is that never compartmentalize equity return in 1 year. In 2017, small cap funds had delivered between 50 to 100% return. That return was certainly not belonging to 2017. It probably delivered return for 2018 and 19 as well. And we did see that 2018-19 small and mid caps delivered negative return. So don't invest in equity compartmentalizing 1 year return. There will be periods like 2017-2020 where you will make a lot of money. There will be periods like 2018-2019 where you will lose money. We still believe that the future direction of market will be volatile. We are not going to see days like post-budget where every day market keeps on going up. There will be days when markets will come down. And the direction of market will now depend largely on how we execute this budget. This budget has bold intent. It's trying to take India's growth in the territory which we have not seen. But it needs to be supported by flawless execution.
All right, Nilesh, thanks so much for joining us. Great speaking with you as always.
Thank you.